Listen, my friends, I'm going to tell you something, and this information can truly change your life. 3 months ago, a woman named Patricia walked into a mortgage office with a credit score of 621. The loan officer informed her that yes, she could get a loan, but the interest rate would be very high, nearly 7% on a 30-year loan. My friends, on a $350,000 home, that meant more than $180,000 in extra interest compared to someone with a perfect score. Patricia asked for 90 days to fix her score. The officer smiled politely and said, of course, but told her not to expect a miracle. Scores change slowly, he said. 93 days later, Patricia came back and her score was 761. The officer asked if she had given the wrong social security number because he couldn't believe it. Patricia said no, because she had learned a mechanism that the finance industry knows very well, but has zero incentive to tell you about. And that 140-point jump saved her more than $215,000 in mortgage interest. Same house, same income, same person, but different knowledge. I've been inside this game for years, my friends. I've founded companies, made investments, and navigated credit processes worth millions of dollars. And I can say this very clearly, the financial system was designed for banks, not for you. Today, I'm going to tell you exactly what Patricia learned, because there is no moral justification for keeping this information hidden. First, let's understand why the standard advice traps you over the years. What you're told is this: pay your bills on time, keep your balance low, don't open new accounts, and wait for years, wait for decades. This advice isn't wrong, my friends, but it is deliberately incomplete, because every month you spend at the mediocre score, you're making money for the bank. Someone with a 680 score who could have a 780 pays higher interest, gets worse terms on auto loans, signs a more expensive mortgage, pays higher insurance premiums in some states, and puts down larger deposits on apartments. The credit score tax is loaded onto the backs of those who can least afford it, and the traditional slow road condemns people to pay that tax for years. Now let me tell you what Patricia discovered. It's called the authorized user trade line strategy. You can't understand this without knowing how your credit score is calculated, so let's go through it quickly. Your score is essentially a statistical estimate of the probability that you won't be able to pay your debt in the next 24 months. The biggest factor at 35% is your payment history. Do you pay on time? The second biggest factor at 30% is your credit utilization ratio. How much of your available credit are you using? The third biggest factor at 15% is the length of your credit history, the age of your oldest account, your newest account, and the average age of all your accounts. Most people think at this point, credit history length is only a matter of time. I opened my first card at 18, I'm now 30, I have 12 years of history. There's nothing I can do. I'll just wait. This assumption is wrong, my friends, and that's exactly where the loophole is hidden. When you're added as an authorized user to someone's credit card account, the entire history of that account appears on your credit report. The account's age, payment history, credit limit, and utilization ratio are transferred to your profile as if you had been part of that account from the very beginning. Read that again, because the implications are significant. If your mother has a credit card she opened 23 years ago with a perfect payment history and low utilization, and she adds you as an authorized user today, that 23-year-old account immediately appears on your credit report. Your average account age can jump overnight from 2 years to 12 years. Your total available credit can double or triple. Your longest account history can extend by decades. That's exactly what Patricia did. Her mother had 3 credit cards with a combined age of over 40 years, a perfect payment history, and utilization rates below 5%. Patricia was added as an authorized user to all 3. Within 2 billing cycles, these accounts appeared on her credit report. Her thin credit file suddenly looked substantial. Her short history suddenly looked well established. Her score jumped 140 points. Let me give you another example to show how this strategy works under different circumstances. Marcus was 24 years old with a credit score of 589. He had made mistakes in college, missed a few payments, maxed out a store card during a difficult period. He was trying to finance a used car, and every dealership was offering him interest rates above 14%. His grandfather had credit cards going back to 1987. Perfect history. Total limits over $60,000. Consistent utilization below 3%. His grandfather added Marcus as an authorized user on his 2 oldest cards. He did not give him a physical card or access to the accounts. The addition was purely strategic. Within 60 days, Marcus's credit report showed accounts with 37 years of perfect payment history. His average account age rose from 2 years to approximately 19 years. His available credit tripled. His score jumped to 697, crossing the threshold that gave him reasonable auto financing at 6% instead of 14% on a $25,000 auto loan over 5 years. That difference saved Marcus approximately $5,200 in interest. His grandfather's simple action, which took about 10 minutes, instantly transferred decades of accumulated credit credibility. Now let me walk you through step by step how to apply this strategy effectively, because the details matter, my friends. Rule 1. The account you're being added to must be in good standing. Ideal is a perfect payment history. Any missed payment will hurt rather than help. Utilization should be low, ideally below 10%. The account should be old. The older the better. The credit limit should be high relative to the balance. Rule 2. The primary account holder must be willing to add you. This typically requires family members or very close friends. They are giving you access to the positive history in their profile. In return, they need to find you trustworthy. Many people add authorized users without giving them a physical card. Rule 3. Not all issuers report authorized user accounts to all three credit bureaus. American Express, Chase, Bank of America, Capital One, and Discover generally report authorized users. Some smaller banks and credit unions do not, so verify this before applying the strategy. Rule 4. The impact becomes visible within 1 to 2 billing cycles after being added. This means you don't need to wait months or years. When the issuer reports the account to the bureau, the history is transferred almost instantly. Rule 5. You can always be removed as an authorized user, and the account will eventually fall off your report. This makes the strategy low risk for the primary account holder. If circumstances change, they can simply remove you. Now, my friends, I know the question on your mind. Is this actually allowed? Is it legitimate? The answer is absolutely yes. The authorized user system exists intentionally within credit scoring models. Both FICO and VantageScore include authorized user accounts in their calculations. The practice is explicitly legal and officially recognized by the credit bureaus. So why does the system work this way? Originally, authorized user reporting existed to help spouses build credit. One spouse might manage all the finances and open accounts only in their name. The other spouse, despite being part of a financially responsible household, might have no credit history. Authorized user status solved this problem by allowing the credit-building spouse to share the history. Over time, people realized the mechanism extended beyond spouses. Parents can help their children build credit. Anyone can help anyone. The credit bureau saw no reason to restrict this because it reflects a real financial relationship. Some critics have called it a loophole that should be closed, but the finance industry has largely ignored those calls because changing the system creates other problems. For now, the strategy is fully functional. There are some limitations you should know about. Some mortgage lenders examine authorized user accounts during the underwriting process. Even if your score reflects them, they may disregard these accounts when making their assessment. This is more common in manual underwriting than in automated approval systems. Patricia's lender used automated underwriting and accepted her score at face value. Now let's go beyond authorized users, my friends, because this system contains other loopholes as well. The second strategy involves understanding exactly when utilization is measured and reported. Your utilization ratio, how much of your available credit you're currently using, makes up approximately 30% of your score. Traditional wisdom says keep it below 30%. More sophisticated advice says keep it below 10%. The true optimal target is between 1 and 3%. But what most people don't realize is this. Utilization is calculated based on the balance reported to the credit bureaus, which is typically the statement closing date, not the payment due date. You might pay your credit card in full every month, never pay interest, and use your cards responsibly. But if you're spending $2,000 a month on a card with a $3,000 limit, and that balance shows on your statement, you're reporting 67% utilization. Your score is being penalized despite the fact that you pay in full. The solution is simple, my friends. Pay your balance before the statement closing date, not before the payment due date. If you bring your balance down to $50 before closing, a utilization rate of under 2% is reported to the bureau. Your score can jump nearly instantly by 20 to 40 points just by changing when you pay. This timing trick kicks in within a single billing cycle. No months of waiting required. The third strategy concerns credit limit increases and their surprisingly large impact. Utilization is a ratio. You can improve it by reducing the numerator, your balance, or by increasing the denominator, your credit limit. Most people focus only on balances. The limit side is mostly ignored. Many credit card issuers offer limit increases without a hard inquiry on your credit report. American Express is particularly well known for this. You can request an increase through their app or website and often get approved for significant limit increases with only a soft pull that doesn't affect your score. Doubling your credit limit instantly cuts your utilization ratio in half. If you're carrying $2,000 on a card with a $5,000 limit at 40% utilization, when the limit rises to $10,000, you drop to 20% with no change in your behavior. Your score improves simply because the math changed. The best approach is to request increases from all your cards every 6 to 12 months. Every increase improves your utilization ratio and your available credit metrics. Within a few years, someone who started with a total limit of $10,000 can accumulate $50,000 or more just by asking periodically. Banks rarely advertise that you can request limit increases. They don't even encourage it. The fourth strategy concerns strategic account management, which most consumers do exactly backwards. Traditional wisdom says closing old accounts hurts your score, so don't close anything. This is partly true, but mostly misapplied. What truly matters is the age of your oldest account and your average account age. Closing a relatively new account can actually help your average account age. Closing your oldest account, however, will definitely hurt. The strategic approach involves understanding which accounts to keep and which can be closed without damage. That store card you opened 2 years ago to get 15% off, if it's dragging down your average account age and providing no benefit, may be worth closing. Meanwhile, your oldest credit card should remain open forever, even if you rarely use it. The fifth strategy concerns rapid rescoring, which most consumers don't even know exists. When you're in the process of a mortgage application, time is critically important. Changes appearing on your report through normal channels takes 1 to 2 billing cycles. Rapid rescoring, however, can update your score within days. How does it work? Your mortgage lender can request that the credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance and provide proof, and the updated zero balance can be reflected within 72 hours, rather than waiting for the next billing cycle. Rapid rescoring is not offered directly to consumers. You can only access it through a lender during an active mortgage application. But knowing it exists allows you to time your credit optimization during the mortgage process, rather than months before. The rapid rescoring window creates opportunities for last-minute dramatic improvements. Someone who pays off a $5,000 balance in the middle of an application can see their score updated before the final approval. Someone added as an authorized user on a parent's account can see that account reflected in days rather than weeks. The combination of strategies applied together with rapid rescoring can produce jumps of 50 to 80 points during the application process itself. Now let me address the mistakes that most commonly sabotage these strategies. Mistake 1. Choosing the wrong authorized user account. An account with high utilization will hurt rather than help. An account with any missed payments in its history will transfer those negatives along with the positives. An account that is only 3 years old provides minimal benefit if you already have accounts of that age. Carefully review accounts before being added. Mistake 2. Applying for new credit while implementing these strategies. Every hard inquiry temporarily drops your score by 5 to 10 points. Opening a new account reduces your average account age. People often undermine their optimization efforts by opening new accounts that work against them. Mistake 3. Inconsistent timing and utilization management. Paying before the statement closes only works if you do it consistently. 1 month of high reported utilization can erase months of careful optimization. Set calendar reminders for a few days before each statement closing date. Mistake 4. Impatience. These strategies work within 1 to 2 billing cycles, but when you're anxious about an upcoming application, that feels slow. People sometimes abandon the approach before giving it time to appear on their reports. Trust the timeline and pull your reports after 2 full billing cycles to verify the changes. Now let me give you a comprehensive action plan based on where you currently stand, my friends. If your credit score is below 650, the authorized user strategy offers the greatest potential impact. Identify family members with old accounts, perfect payment histories, and high limits. Ask to be added as an authorized user on 1 to 3 accounts. At the same time, address negative items on your report that are inaccurate through the appropriate dispute channels. Bring any credit card balances below 10% of the limit before your next statement closes. If your score is between 650 and 720, you're in the optimization zone, where multiple small improvements can create significant gains. Request credit limit increases on all your existing cards. Adjust payment timing to reduce reported utilization. Consider the authorized user strategy if you have thin file issues or a short account history. If your score is above 720, you're probably in good shape for most purposes, but optimization still matters for the best mortgage rates. The difference between 750 and 780 may seem small, but translates into meaningfully different interest rate offers. Focus on utilization timing, limit increases, and maintaining the positive patterns you've already established. Regardless of starting point, everyone should pull free credit reports from all 3 bureaus annually and examine them for errors. Research consistently shows that a meaningful percentage of credit reports contain errors significant enough to affect scores and credit eligibility. eligibility. Disputing legitimate errors should happen completely separately from and alongside the strategies I've described. My friends, beneath all these tactics lies a deeper truth that should fundamentally change how you think about credit scores. The credit scoring system was designed for lenders to estimate risk on behalf of those who lend money. It was not designed to help you optimize your financial life. It was designed to help banks decide how much money to charge you. The system surfaces certain information and obscures other information in ways that serve institutional interests ahead of consumer interests. Banks don't explain the authorized user strategy because it helps you escape their higher rate products faster. Credit bureaus don't advertise utilization timing because complexity keeps consumers dependent on credit monitoring services. The entire industry benefits from people believing that credit improvement is a slow, mysterious process requiring patience and perhaps paid assistance. The truth is that credit scoring follows mechanical rules. There is nothing wrong with knowing those rules. Once known, they can be optimized. The gap between people who understand the rules and those who don't translates directly into wealth differences over time. Someone who maintains a 780 score instead of a 680 will pay dramatically less interest over their lifetime. Lower mortgage rates, lower auto loan rates, better credit card terms, reduced insurance premium. The savings compound over decades. These strategies work because you're operating within the actual rules of the system, not within the simplified stories told about those rules. You're not cheating. You're not exploiting loopholes. You're using features that exist by design but are not promoted by institutions that profit from your ignorance. Patricia's 140-point jump in 93 days permanently changed her financial trajectory. The $215,000 she will save in mortgage interest will fund her retirement. This knowledge she acquired will apply to every credit decision she makes for the rest of her life. That same knowledge is now in your hands, my friends. This isn't hidden because it's illegal or unethical. It's hidden because no profit-motivated entity benefits from you knowing it. Now you know this secret. What you do with this knowledge is up to you.